folks, we're kicking 2021 off by doing a full portfolio reveal of the 19 positions in my $244,000 dividend stock portfolio. We're going to project out over the next decade what those dividends might do if I just reinvest them in the portfolio. We're going to go over the newest positions I add. We're going to touch base on the most controversial positions and so much more. So consider slapping that like, folks, and let's get right into this as I currently track my portfolio on trackyourdividends.com. Taking a look at the portfolio, which currently says it has a capital gain valuation of $83,000. That is not accurate because obviously as you sell positions, add new positions, you kind of lose those capital gains that are baked in to the current share prices. Most of my accounts set up over 200% after 7 years of investing to get to this point, folks. I think it deserves a little bit of an applaud. This is some incredible stuff. So I'm hoping you're getting value out of this video as we're going to go through all of my 19 positions at a current dividend yield, even with my growth stocks, sitting around 3.59% with an annual income equivalent of $8,750, which doesn't include the dividend cuts I'm about to experience on some of my largest holdings, being RioCan, which is going to knock somewhere between $600-700 off that, bringing it closer to $8,000. But luckily over the last few days, I've added some new positions trying to rebuild those dividends up so it cushions the blow when it comes in February, but we'll touch base on that moving forward. So let's scroll down the list and start at the very top. Being Apple here, folks. Now, Apple, no matter how many times, if you're OG, you might remember the YOLO Wolf days.
Shut up! Oh my God.
I've watched people countlessly short Apple and be proven wrong time and time again. This company is innovating at a level that people just never begin to appreciate. They're trying to get into self-driving, the EV market. They're trying to partner with Hyundai. I don't know how much of that is speculation. Over time, I'm sure we'll become more and more aware. But my favorite thing about Apple, they just innovated the M1 chip, which is highly underappreciated. They dropped, I think it was Intel, the chip makers. Now Intel, AMD, all these chip makers have to catch up with this new technology that is better than anything has ever been. A lot of people thought Macs were way too overvalued laptops, guys, but considering the MacBook Air is $1,000 and it performs better than a $5,000 or $6,000 gaming PC, I just don't think people are technologically inclined enough to understand how fast and how great Apple is being. So I've got 100 shares, not going to touch it, going to let it sit there and ride. I did pull some money out of it last year, but I'm going to do my best to not do this year. But taking a look into the next position, one of my newly added positions called ARKG, the ARK Genomic Revolution ETF. Now, this is a Cathie Wood favorite of mine. It is the first ETF I ever bought, and it's only because I believe that healthcare is going to outpace FANG. Heck, it might even outpace Tesla in the coming 5 to 10 years, considering this is the first time in our history where we're talking about curing cancers, pediatric blindness, HIV, all kinds of crazy stuff that no one's ever been able to say before. And like I said, I'm smart enough to recognize what is happening. I'm not smart enough to recognize what individual companies are going to do the best, because you could say it's CRISPR. There's a ton of other ones in that list, but I do, however, trust Cathie Wood.
Now think about it. Apple is $1 trillion market cap company, and it's changed our lives, and we love our Apple phones and AirPods and watches. But Apple is not curing cancer. It's not curing disease. These companies, we believe, will. But there's so much fear in the marketplace, and there are all kinds of reasons to avoid them. The cap is too small, which is this kind of circular reasoning. The cap is too small, or they've just entered human trials. I'll wait to see what happens. Well, that'll be too late if these human trials are successful.
And this is where I'm willing to make the bet on the ETF and get the broader exposure. So I am not done scaling this position. I bought a little bit more actually the other day. I've got 36 shares. I would like to build this into about a 70 to 100 share position over the next coming months. Moving into the next stock here, folks, taking a look at Alibaba, my most controversial holding right now because I sold Tesla to buy it. Oh my God, did I cause a shitstorm in the comments section below. Why did I sell Tesla to buy BABA? Well, luckily trackyourdividends.com gives me a little bit of an analytical tool, and I just want to show you right now Tesla's Comparison in price to earnings valuation against Facebook, against McDonald's, against Baba, Starbucks, and Amazon, guys. Now, don't get me wrong. I am a long-term bull on Tesla, the company. I was just watching Financial Education go on his bull case. He recently released a video. It was very entertaining, but my reason and conviction to not holding Tesla shares anymore, which might have been a mistake, and I'm going to explain to you why. But first, my main conviction is that everybody is hyping this company on the idea that it's going to be generating more than $200 billion in revenue by 2024, 2025. But this is highly predicated on the fact that self-driving is going to be fully regulated and producing revenue. The idea that we're going to see battery walls and solar roofs explode, like all of this stuff sounds so great. The problem is none of it exists, and it is already priced into the idea that it does exist. Kathy's Wood bull case originally on Tesla was $4,000 to $7,000 a share pre-split. We are there now, guys. Tesla's currently worth over $4,000 pre-split a share. I was sitting up over 700%. I like buying companies when people hate them, when they're suppressed, and that is not Tesla right now. I bought Tesla in 2019 here, guys, and I just felt a lot more comfortably taking that profit off the table, at least until some of this stuff gets proven out. I'll have no problem watching Tesla run up to a $2 trillion market cap. If that's what happens, so be it. But until these technologies get proven, I'm going to sit on the sidelines, and heck, I'll have no problem paying a premium getting back into it. And as of today, I had 10 shares. If I kept those shares, I would have been up an extra $3,000. And if I was smart, I would have done what Kathy Wood did in the ARK Innovation ETF, which is, they make Tesla a 10% weighting, and every time it runs up 20 or 30%, they simply scale it down. I mean, even ARK ETF sells at a Tesla and they buy it when it drops. So if I was smart, maybe that's what I should have done. But when I look at Baba, guys, it meets all my criteria, highly suppressed by media that just isn't true. It's so blown out of proportion that it has driven the stock down way too much, considering the growth rate on Baba right now is faster than Tesla's, guys. Its forward PE is better than almost any of the tech giants that currently exist in the US, and it is my first foreign exposure to China, which comes with a little bit more political risk, obviously, but not the kind of political risk and bullshit that we currently see in the headlines that Yahoo Finance even writes here. And it's going to be neat to see how this plays out, because I currently think it should at least be a $300 stock, and every single analyst currently has a buy rating on the company here, which, by the way, I just want to shout it out, guys. Trackyourdividends.com is an incredible website. I like how they bring my whole portfolio together and convert it to CAD conveniently for me, very accurately as well. And they give me these analytical tools so I can conveniently compare all my stocks side by side. They have little alerts that'll actually email me when I'm getting dividend payments, which the vast majority of these tools are already free. So I highly recommend you come over to trackyourdividends.com. I'm going to leave a link in the description below. But if you guys want the advanced tools, you want to support my channel, consider signing up to the pro version. It is only $60 a year. I reached out to them so I could affiliate with them because I truly like this product so much. But enough promoting. Let's get back into the portfolio here, folks. Taking a look at the next stock in the list being one of my banks that I recently purchased last year when I scaled down Apple just slightly to scale this up, and it was a great time. I mean, we're talking about Bank of Nova Scotia here, guys. I am up over 30% when I purchased those shares. I capped in over a 6% dividend, and banks are banks are banks. I'm going to be taking these to the grave with me, and I like these stocks because I call them my dividends for today. These are the kind of companies I don't care if the capital gains are up or down, so long as they keep paying those high yields and I'm able to rediverse them elsewhere. And I love the Canadian banks over the US banks because I told you guys, Canada is currently one of the top fastest growing first world nations. It is growing faster by population than the US and even India right now, which is pretty staggering because that also expands the growth rate of the financials, because obviously people move here, they buy real estate, they need banks. And this is why I love my Canadian banks. Moving into the next one, we got British American Tobacco, another sin stock of mine. These ones come with a whole different level of risk because I think fundamentally they're cheap as hell. They're incredibly valued, but my capital gains are constantly up or down on them. And honestly, the stock price is highly inflicted by how society thinks about them. And if society just says, forget these stocks, the price could continue to decline. But this comes back to my banks as well. These are stocks that I don't think are going to go anywhere for the rest of my life. And I'd rather own them for dividends today, especially high yield dividends that are very reliable, that I can start redirecting into other companies, maybe even like ARKG TD, which again leads into another bank we have here being Canadian Imperial Bank. And just to give you guys a little bit more disclosure, BNS has like global diversification. They have, I think, stuff going on in Colombia, a little bit more like Latin America kind of exposure. Whereas Canadian Imperial Bank is primarily focused on mortgages, and especially Canadian mortgages. So people thought that it was going to get hit the hardest in the pandemic, but it turns out most people paid their mortgages because Canada is very strict on their stress testing. And I love this company because it's one of the highest yielding banks. And yeah, we're going to see TD as well when we get down the line. And TD is for my US exposure. But yeah, I kind of like, they're like Pokemon cards. I kind of got to collect them all. Sooner or later, maybe I'll buy BMO or Royal Bank or something, but who knows? Moving down to my favorite stock in the tech world has to be Facebook. I got 40 shares of this company. I might consider buying a little bit more of it, but honestly, if I could recommend any tech today over Apple, Microsoft, all of those companies, even Amazon, I would have to pick Facebook. People think it's getting highly suppressed, being called a monopoly. The government wants to suppress if they can buy any new companies.
Zuckerberg, I remember well your first visit to Capitol Hill back in 2010. You spoke to the Senate Republican High-Tech Task Force, which I chair. You said back then that Facebook would always be free. Is that still your objective?
Senator, yes, there will always be a version of Facebook that is free. It is our mission to try to help connect everyone around the world and to bring the world closer together. In order to do that, we believe that we need to offer a service that everyone can afford, and we're committed to doing that.
Well, if so, how do you sustain a business model in which users don't pay for your service?
Senator, we run ads.
I see.
But this is the only company in the top 10 S&P where I could easily see how they're going to double their revenues. They haven't monetized WhatsApp. They're the Coca-Cola of ads. They could easily increase their ad rate by 2 cents. They would still be cheaper than Google, and it would raise their revenues by like tens of millions of dollars. So this is one that I'm on the edge. Maybe buy more. Maybe I'll buy more. We'll see where the year takes me. Back into another sin stock. Next on the list, we got GEO Group, my prison REIT, which comes back to the point of my sin stocks with British American Tobacco. Sometimes, guys, society beats these things so heavy into the ground. We had a Biden win, which doesn't do well for the prison sector. This is currently the cheapest REIT in the entire real estate investment trust sector. The dividend yield over 15%. The payout ratio is only 50%. And every time I look at it, guys, I have a hard time wanting to sell it. I'm down 50%. It's my worst performing stock. And the fundamentals scream a buy to me. I'm not buying anymore just because, again, the risk and the suppression going on with it. But I'm going to tread lightly with it. I'm not going to sell any, not going to buy any, just going to hold it. And like I said, reinvest the dividends I get paid. Moving finally into a stock I can speak highly of, healthcare sector. I loaded the boat. In fact, a lot of the Tesla profit I took went into Johnson & Johnson. I'm trading up pretty nicely on this one already. My average buy price was at an incredible point of 140 a share. I got 85 shares of it, guys. And this is one that I think if I had to recommend one stock every single person should own in their portfolio, it is Johnson & Johnson. It is like a healthcare stock that is an ETF in and of itself. I mean, you're getting pharmaceuticals, you're getting medical equipment, and you're getting consumer staple brands like Tylenol. So one of my favorites of all time, of course, many of you know that. And if you agree, consider hitting that like button, folks. But taking a look at one of my newer positions, which I'm kind of having a little bit of a kerfuffle with because I just watched Jim Cramer from CNBC television ream this company out.
Ooh, what's not to like, right? What's not to like? Let me buy some. So, what's the problem? Simple. I don't expect Kimberly-Clark or Coca-Cola stock to be sustainable investments right after COVID is conquered. Once the economy is roaring back, Wall Street will have no interest in these slow and steady growers. They'll want cyclicals, like I mentioned earlier. Plus, those dividends, they won't protect us as interest rates start heading higher because 3% is just not big enough.
It doesn't think it's a good buy. I've been picking it up because it's a PPC Ian favorite. I love the higher dividend yield. I kind of compare it to Pepsi. They do a lot of, it's your toilet paper stocks, right? I'm going to continue to probably buy a little bit more with the dividends if it continues to dip. I don't know. You guys let me know in the comment section below. What do you think about Kimberly-Clark? Think it's a good buy, bad buy, kind of on the edge with it. Leading into my second most controversial holding, having to be MindMed. MindMed is one that I recently just scaled down slightly. And I kind of, in my last MindMed video, I made a bit of a mess up, a little bit of a mistake, because I said that they only had just over 100 million after the recent share dilution in cash, but actually they have like 180 million. They have enough money now to get them through all their trials. It's going to be one of my riskier plays, but as I told you guys, in the healthcare sector of the market, in the psychedelic sector, I believe this company has the most potential for actually having really good results on their phase trials. So this is like my hand-picked company in the healthcare sector. ARC-G is like my Kathy Wood pick for growth in the healthcare sector, along with MindMed. And then for the safer of the bunch, I picked Johnson & Johnson, which you guys are going to start to realize that healthcare is going to be becoming one of my largest weightings in my entire portfolio, because I just believe it is going to be the future of growth amongst most of the market sector right now, aside from renewables and obviously the EV market. But taking a look, we have MO in here. If you're looking for MJ stocks, guys, I highly recommend buying MO to get exposure to Cron. MO obviously being a sin stock, another smoking company, but if you're positive on where the MJ markets are going, you got to be positive on MO. And if you want a safer, secure way of having exposure to that with a really high, reliable dividend, MO, top of the list, beautiful company. I love it. Almost done here, folks. Taking a look at Microsoft. Microsoft to me is a company that is desperately trying to grow revenues. This is the same thing with Amazon and a lot of other, even Facebook could probably fall into this category. What most people don't realize is Microsoft, Apple, Amazon, they have so much bloody money that nobody really cares about their cash. The only thing they care about is the growth on revenue rate. Microsoft recently purchased GameStop, which seemed like a really stupid decision because it was basically going bankrupt. But honestly, the way Microsoft looks at it, they're like, if we burn this money, but it raises revenue even slightly, it's going to look better on that EPS when they come out at their earnings, right? And I mean, we saw Microsoft make a huge mistake trying to compete with Twitch. I mean, they just throw money and do everything they can to grow. They did a huge partnership with Pepsi, guys, which was pretty incredible. It's going to raise their revenue by over $1 billion. And that's all cloud computing based. But I also believe Microsoft, Apple, they're like buying individual company ETFs. Love it as well. Leading into my actual I call this my new Tesla stock. I've held on to this for 5 years. Northland Power, guys, just hit all-time highs today. It cracked over $50 a share. This is what I define as the best monthly paying dividend stock of all time. There is no better monthly paying dividend stock with the kind of performance I've gotten out of this. You can rebuttal me. Let me know if you can find one better in the comment section below. But I haven't sold a single share. This company pays me $50 a month. I'm currently sitting up $25,000 on this stock. I absolutely love it, guys. One of the Biden plays, and yeah, because it's in the renewable sector, yeah, it's not growing at Tesla's rate of like 10-15% here, but it is already trading up, I think, 6 to 10% on the year alone. Moving down the list, we got to talk a little bit about Pepsi. PepsiCo, another one of like the PPCE favorites. It is definitely one of my favorite consumer staple stocks of all time. Again, Pepsi completely came from Tesla, by the way. 100% of my Pepsi position, all 69 shares, the entire valuation in this all came from Tesla profits. So thank you, Tesla, for those 700% gains and building out a lot of these new positions, including Kimberly-Clark, including Johnson & Johnson, and Pepsi, which I'm going to sleep a lot easier at night owning these, collecting those dividends, than I would owning Tesla, even though, again, shooting through the moon, right? Now, the controversial one here in my REIT sector being RioCan, the dividend cut is coming up. I always told you guys that when we head into the second lockdown period, which is where we're at in Ontario, something tells me in the US when Biden comes in, there's going to be a second lockdown. I always said that RioCan, any of the Canadian companies aren't going to get hit as hard as they did in March, and that's what we're seeing now. RioCan not getting hit as hard. They're going to be volatile throughout this year. I still think they're trading at a good price if you're looking to buy into them, but with the dividend cut, it basically made them so robust. They're basically the best Canadian REIT. Current fundamentals after the dividend cut, I mean, you're still getting a super high yield over 5% if you're buying it today. You're still getting the best Canadian REIT, the largest Canadian REIT. Love it. I still believe in the future potential. Haven't sold a single share. And when we get into my portfolio diversification, you're going to see how large of a position this is for me. Finally, into another utility, because Northland Power is a renewable utility for me. But Southern Company, if you're looking for a better PE ratio and you're trying to get into renewables, Southern Company, again, like being a utility ETF. They're getting into solar renewables, all kinds of cool stuff. They deal with nuclear, all kinds of different power. They're one of the largest utilities in the US, pay a higher dividend yield than most of the renewables. And I've held on to this one for a very long time, and I still love it. I still think it's a buy. today, which leads me into the newest position I have added. This is the 19th position I've added to my portfolio, Stag Industrial, guys. I really wanted to own Amazon, but this is a fun way for me to get exposure to Amazon without actually owning it directly and getting a really healthy 4.8% dividend yield. I bought 101 shares. This is where some of my MindMed profits went because I had to sell MindMed down a little bit, only because I wanted to transfer money into my TFSA because I can generate money tax-free in there. And it just made sense. So I put some of that money into Stag at $29.87 a share, an incredible price in my opinion here, folks. I'm already up slightly on the position here, guys, but Stag basically is a logistics kind of fulfillment center. They already have partnerships with Tesla. Amazon is their largest tenant. And keep in mind, that largest tenant only makes up like 3% of their income. It is such a super safe, growing sector of the real estate market. It's one of the best performing sectors in this pandemic, and I've been dying to add it, and I'm so glad I've been able to finally kind of dip my toes in here, guys, with the final position in the portfolio being TD, which I already touched base on, so I don't think I have to reiterate any farther. But those are the 19 positions. So how are these weightings looking? Bringing all of this together into one pie on trackyourdividends.com, guys, we can see that my three largest positions are made up of RioCan at 10.9%, Northland Power at 10.35%, and MindMed at 10.61%, combined making up 30% of my portfolio. And what I love is every single one of those is in a completely different sector of the market. They all have interesting prospects in my opinion, which is why I love the percentage weightings, because RioCan is kind of like a recovery play, a high dividend yielder for me, and it gives me exposure to some of the greatest real estate in Canada. Northland Power, global diversification in the renewable space. They're getting into New York contracts, going to benefit heavily from the Biden win. And then obviously MindMed being an aggressive growth play for me. Beautiful company in my opinion, and I'm glad that it makes up a decent weighting. The thing I love most about trackyourdividends.com here, guys, which again, if you want to support the channel or heck, even try it for free, click the affiliate link in the description below and just let me know what you think. But taking a look, guys, if you were to just reinvest my dividends of that 8,700 and I were to never focus on capital gains ever again, by 2030, if things just are relatively unchanged, my portfolio will be sitting at $385,000 just from the beauty of compound interest with just my current dividend yield, not including any capital gains here, folks. So this is some pretty incredible stuff. And it would project out that my dividend income by 2030 would be roughly $26,000, guys. That's not even a decade from now. I won't even be 40 years old, and I'll basically be at pretty close to retirement if I continue to throw money at the portfolio and not touch those dividends. But you guys know, I'm documenting my financial independence, retire early journey, my passive income sources to get me there by the time I'm in my mid-30s. I'm still 28, guys. So in 7 to 10 years, between 35 and 40, I plan on being at that retirement age where I'm going to survive off this portfolio along with my other income sources. So you can consider subscribing because I'm going to document the full thing here. And I'm hoping I am going to slaughter this chart. This chart is going to be a joke in comparison to where I plan on growing this portfolio to. So in light of all this, guys, I passed the question off to you. Welcome to 2021. It's already been a shit show of a year. We're getting into curfews now here in Ontario. I live up in Canada. It's going to get crazy. It's going to get wet and wild, and I'm hoping you're going to stick around for the ride. So consider subscribing if you guys enjoy the clarity of my transparency. I look forward to catching you all. Well, actually tonight, if you want to join us on our live stream channel over at the Passive Income Educator, we go live every Friday at 10 p.m. But if not, I'll catch you tomorrow.